I help people to plan their financial future. I have more than 15 years of experience and helping people across India and globe. Nowadays, I am getting lot of questions. Out of this, one question is why multi-asset portfolio is very much important and why you normally prefer financial planning and multi-asset portfolio. When you start your investment, that point of time, financial planning is very much important. Once financial planning is done, you broadly understood what is your overall direction, then you need to go and start your investments. While you start your investments, that point of time, you need to consider two or three factors. Your portfolio, you need to manage risk of your portfolio very carefully. One may be uncertainty kind of risk, which you can consider by taking term insurance or health insurance. Second is when you are investing, that point of time, your investment has lot of risk. One risk may be market cycle risk. What does it mean by market cycle risk? There are the scenario where everything is business is going good, they are doing good, they are making profits, and that profits distributed to shareholders, and economy is doing good. So that point of time, you should you should invest into equity. Suddenly, what had happened? Sometimes some uh, uncertainty came, like your some uh, maybe some war, some like COVID kind of scenario. Okay, that point of time, people think equity is not a good asset class. Business may disrupt any point of time, so they invest. They may park their money into safe haven like gold. That point of time, equity may fall down and gold uh, may come up. So, so now you understood why this particular diversification is needed. Now, third level is your interest rate risk. Maybe you may see ki when any country is money, they are trying to reduce their interest rate. When interest rate is down, that point of time, people will think, ki, what would happen? Why should I keep my money into fixed income instrument instead of putting over there? I may transfer my money to equity, which may give us better return. Okay, if the situation is opposite, like you have a very huge inflation in your economy. So what would happen? That point of time, you'll have your economy, your people will have more liquidity, more money, and good supply is very limited. What would happen? For simple to simple things, maybe with this pen, if in normal scenario, if it is 100 rupees, if you have more money and production of this particular pen is very much minimum, that means supply is very much minimum, that point of time, you may give you may tend to give higher cost for this particular pen. Maybe you may give 200 rupees for this particular pen. So that is why to reduce this particular uh, liquidity, government may increase interest rate. And when they increase interest rate, that point of time, people may think, why should I take risk? Instead of taking risk of equity, I'll I'll put money into fixed income instrument, which may give me high return. And what had happened? This particular scenario, when COVID came, that point of time, uh, country like US. They print out lot of money and inject to economy. For that particular reason, what had happened, their inflation went up, and Fed, their central bank, they increased the interest rate. When they increased the interest rate, what had happened in from emerging economy like India, then China, and all, from this particular emerging economy, equity, uh, investor pull out money from equity market, and they transfer this money to US uh, bond. People who invested into debt oriented funds or balance advantage kind of fund, they make good amount of money. Over the period of time, what would happen key when US inflation come into control and Fed reduce their interest rate, that point of time, people will think they are not getting enough return from US bond, and then again fund may flow to equity, and then equity may come up. Why I told you all this story to make you understand ki how this particular market cycle works. Now, the thing is, say for example, you invested, uh, you don't know about any market cycle, and you saw ki when equity is up, you just saw some past performance of some mutual funds and ask your friends. They told ki this fund gave me very good return, and you blindly invested into that without doing any research, and you have started SIP when market is up. So you are accumulating your units in higher prices, and then when opposite cycle come, market crash, bear scenario come in the market. That point of time, your fund may be negative for a very long period of time, and you cannot understood why this fund is negative for a long period of time, and you pull out entire money. So what would happen this point of time? If you without understanding, if you pull out entire money, uh, then definitely it would be a big loss for you. Maybe you should wait for next cycle to come and average it out when market is down that point of time in lower prices. Amen. As a simple investor, you may not understood all this technicality. For that reason, if you start your investment into multi-asset approach based on your risk appetite and time horizon, that is why investment professional is very much important, and you should come to investment professional to uh, from very first day to understand ki whether you are in right direction or not. So you should have some investment into equity. Should have some investment into debt. You should have some investment into uh, then commodities like gold, maybe silver, maybe into real estate. Okay. So each market cycle, you may take advantage of each market cycle, and how and when, that for that you need to study by your own. Otherwise, you may come to any uh, veteran professional. Thank you. Enjoy wealth creation. Thank you.